Hello, investors. Do you know that knowing the right mix of risk and rewards is the core underlying to investing? You invest to earn a return on your money, but returns are not the only consideration. You need to understand risk as well. So, what do we mean by risk? The risk is the possibility of something bad happening, like uncertainty, chance of loss, whereas rewards are the gains on investment. So, as an investor, you always come across questions like how much risk are you willing to take and able to take? Why risk matters? Are you taking enough risk or not? To answer the first and second question, as an investor, you need to understand your risk tolerance. Generally, an investor's risk tolerance scale extends from very conservative, meaning you do not want to risk losing a single rupee, to very aggressive, that you are willing to risk much of your money for the possibility that it will grow tremendously. However, risk tolerance, it's not only about the emotional side of investing, it's also affected by various factors like income levels, stage of life, your investor's ability to handle the loss, and your financial objectives. So, why risk matters? Risk is usually seen from the negative side, but it can have a positive side as well. It's the difference between the actual return and the expected return from the investment, which means it can have the potential to gain as well as the potential to lose. So, you need to understand the amount of risk you take have a massive impact on your future security and lifestyle. So, your range of investment choices and their relative risk factors is often described through a pyramid. The base part consists of lower risk investments that guarantee you that you will get your money back along with the interest at maturity. The medium part contains the limited and the moderate risk alternatives such as mutual funds, whereas the top part contains the higher risk categories which have like shares in company that have no guarantee and you may lose all your money, but in case the company succeeds, your investment could be worth lots of money. So, are you willing to take the risk of not taking enough risk? While risk can mean that you have a greater chance of losing money, it can also be measured by a potential for lower returns than what you need to achieve your objectives. If you do not take enough risk, you may not make enough money. You need to understand, for example, if your goal was to retire comfortably, the lower return might mean that you need to delay your retirement or accept a lower annual income in retirement. So, what's the trade off between risk and rewards? When it comes to investing, trying to balance both may seem like dodging a bullet. Investors don't know the actual return they'll deliver or the ups and downs in the market. Therefore, we can only look backwards to examine what has typically happened in the past, to use that as our assumptions for the future. For example, lower risk investments like bank accounts tend to generate lower returns, whereas higher risk investments like shares tend to generate higher returns on average over time. But unfortunately, the ideal investment with low risk and high returns does not exist. But does taking more risk when you invest actually yields more rewards? Both are always present. Through it is certainly possible to reduce your investment risk and increase your reward if you follow the right investment strategy. So, discuss your goals and needs with your financial advisor and choose the right investing strategy for you. Thank you for watching. Please like, share, and subscribe our channel Hint2Mint.